So, Adam, I mean, there were all kinds of reasons it made sense to anticipate a little bit of chop coming into August. Seasonals, sentiment, technicals, valuation, arguably, yields are doing what they're doing. But corporate America has kind of shown its hand on earnings for the most part this earnings season. Better than anticipated. The consensus is holding up on a forward basis. Where does that leave you in terms of whether, in fact, the market can skate without much more of a correction?
I mean, if you're reacting week over week or, say over the last month, I don't think the data make you more negative.
No.
I think if you were starting July 1 saying I'm 50%, we're up 10, 50%, we're down 10, I'm like 60-40 up now because I think the big companies delivered pretty solid earnings results. Their out-year earnings, the 24 earnings, are up pretty much for all of them. Google, Amazon, Meta. NVIDIA's numbers are up. They didn't even report yet. Right, so I don't think in that broadening debate that I get in every meeting, I don't think you have data that supports selling the big ones yet. So I think the low-end consumer's holding in. I think the dream that 24 could be good is starting to grow. So on the margin, I think the data are slightly more optimistic.
I mean, Apple, that's a little bit of a breakdown that would get your attention if you were just staring at the chart and said, oh, we raced above $3 trillion market cap, and then you get a mostly as expected earnings report and you're down 10%.
Right.
Microsoft trading pretty heavy since its result. I guess the question isn't so much can these big companies deliver on their promise of being resilient and having good profit margins that are defensible, but is the market kind of saying, yeah, we've been here for a while and we priced it in?
Yeah, I think the market was anticipatory, but in order for the rally to broaden, you either have to believe that the other companies are going to have better relative earnings revisions, upside to their margins and earnings, and a better trajectory, or that their multiple is somehow magically going to expand relative. And it is true that cap-weighted universe is very expensive versus the equal weight, so 21% premium. It's about the highest really since the unwind of the tech bubble 20 years ago. So you have valuation support for the broadening, but usually you need the catalyst of the relative margins and earnings to be better. I didn't get that in this earnings season yet. We'll see if that's what's coming. If you do get lower commodities, you get less wage pressure, then that would be the bull case for margin expansion and the broadening. It
seems like you now have most people content in saying that recession watch has been called off for now. Beyond that, I wonder what people are expecting in terms of whether we're just going to be in this kind of late cycle muddle through environment. Yeah, stocks are expensive, but the Fed's almost done. And there's always kind of a offsetting factors that seem like you could argue either side.
Yeah, you get more, equity investors get increasingly anticipatory. I remember, 100 years ago when I covered Intel, they raised CapEx. The stock went up because people thought, oh, demand must be good. They're building the facility, right? Then the next cycle, they raise CapEx, stock gets creamed because everyone saw what happened. They put too much capacity in place. So this cycle, everyone's been increasingly anticipatory. The Fed is not dovish, but everyone knows we're kind of toward the end of the cycle. One more hike, no more, two more. More of it's behind us than in front of us. And so you've seen the relationship between Fed fund futures or the perception about rates and multiples, the price to earnings, totally changed. And now nobody cares. Hawkish, dovish, the multiples have gone up in both cases. So there's no doubt people are anticipating the end of the cycle. So I think, to me, what's interesting is to get to 5,000, so let's call it 10%, a little bit more upside, and that would, I think, is what required to say I'm going to walk in and be bullish on equities incrementally. You got to pay over 20 times the consensus 2024 earnings for the S&P. The market doesn't usually stay at levels that high. So the only way that's right is either there's upside to earnings next year,
right,
or, hey, it is the beginning of a new cycle, and earnings are going to grow, let's say, 5 more years in a row. And, or as far as I can see again, sort of like 2012 to 19. And if that's the case, then, yeah, equities are going to look better.
Or it overshoots to that level and then backs off because none of that comes through.
Or we get the pullback, or we get a 10, 15% pullback. It's got to be one of those three things. And I think when I talk to investors, I think the bull case probability is growing in their minds. You dress the market up usually in an election year. I think people think there could be incremental stimulus from China. There's a lot of incentive to, on decarbonization, on industrialization, on automation. The low-end consumers really comes up and is hanging in there pretty well. So people are starting to have and this could be and that could be thing that's a higher, it's a more plausible, less unicorns and lollipops sort of thing than it was 6 months ago.
Sure.